good morning. Welcome all of you today's morning. Today we will take up a few case study on corporate valuation. So far we have seen different methods of corporate valuation, how the companies are being valued using different methods. We have seen stock and debt approach, net asset value approach, direct comparison approach, and DCF approach, that is the discounted cash flow approach. And discounted cash flow approach, we have seen two-stage growth model and three-stage growth model, and then we looked at case studies on different growth models. And today we look at different types of case study which can be asked besides the corporate valuation, methods of corporate valuation. You may be given financial statements, you may be given profit loss account and balance sheet. From that, you may be asked to calculate Ebite, net profit after less adjusted taxes, cash flow, financing cash flow, all those all those components you may be asked to calculate. So today we look at that type of case study given in the LMS under the heading corporate evaluation, other case studies. So kindly look at that. Today we look at this component of case study, that is the calculation of Ebite, tax on Ebite, and different cash flows. So look at this case study. We have 2 years balance sheet and profit and loss account. It is given, financial statements are given of a company. Net sales is given 5,600 and 6,440 million, and then income from marketable securities, there is 140 and 210, and non-operating incomes, that is the 70 and 140. So total it is 5,810 for year 1 and 6,790 for year 2. So this is the profit loss account on the income side of the account, income side of the profit and loss account. That is sales, income from marketable securities. It could be the interest income, interest that the company is receiving, or non-operating incomes. Could be the dividend received, the company, maybe non-operating income means the income which is not related to business. The income which is not related to business is called non-operating income. So income from capital securities means it is income from capital securities means it could be the interest income, or or the income from other bonds. Predominantly it is interest income. So total it is the 5,810 and 6,790, and then what is given is the expenditure side of the profit loss account, that is cost of goods sold, that is the the trading account, cost of goods sold. Selling and admin expenses, depreciation, interest expenses. The total cost and expenses is 4,606 and 5,362. And there is profit before tax. Profit before tax is total income, that is 5,810 minus total cost and expenses, that is 4,606. You will get 1204. Then tax, that is 364 and 448. There is profit after tax. Then dividend the company pays, then the remaining is taken as a reserve. So this is the profit and loss account of the company for 2 years. Then balance sheet is given. Balance sheet is given. There is equity capital, reserve surplus, and debt. There is the liability side of the balance sheet. Fixed assets, investments, current assets. There is the assets side of the balance sheet. The total is 6,300 million and 7,140 million. So from this information, you may be asked to calculate the following items need to be calculated. That is the Ebite, tax on Ebite, NOPALT, net operating profit less adjusted taxes, free cash flow to the firm, that is FCFF, that is free cash flow to the firm, and then breakup of financing cash flow. So we'll have to calculate the financing cash flow. So these are all the things that we need to calculate. Shall we proceed one by one? So we have to calculate for all this, we have to calculate for the year 2. Okay. So below the case study, notes is given. To solve this case study, the notes is given. To calculate all this, notes is given. So you can look at that notes. It can be used for the section A questions also. So what is NOPALT? What is FCF? All those can be asked. So you can write from this, you can write for section A questions also. So can we proceed? Hello? Shall we start?
Yes, sir. Yes, sir.
Yeah. So what is given? EBIT, earnings before interest and tax. Earnings before interest and tax. We'll have to calculate the profit before interest and tax. Okay, profit before interest and tax. So what is given is profit before tax is given. What is given is profit before tax. Profit before tax it is given. That is profit before tax is what is given is 1,428 million for the year 2. So we need to calculate for the year 2, 1,428 is given. Okay. So kindly look at what is EBIT. So EBIT is, it is before interest. Before interest. So before interest means before interest expenses. So when we say interest expenses before, and you need to, it must be before interest income, and it must be before non-operating income. It must be before interest income, and it must be before non-operating income. So that means interest expenses is deducted for calculating profit before tax. So that need to be added back. Interest income and non-operating income is added for calculating profit before tax. So that need to be deducted to calculate EBIT. Any clarification? Anybody? I repeat, EBIT is before interest expenses, before interest income. Before interest expenses, before interest income. That means we'll have to calculate that profit before that we calculate that we get the interest income, interest expenses. So when we deduct interest expenses, we need to deduct interest income also. But interest expenses is deducted to calculate the profit. Interest expenses deducted to calculate the profit. So that need to be added back because we are going to get before. Interest income is added to calculate the profit because we write on the credit side of the profit and loss account. So that is added. So that needs to be deducted. Okay. So that figure will give us the EBIT. Any clarification? Anybody? Any clarification? Anybody? So EBIT is profit before tax is 1,428. All of you can see that? EBIT for the year 2. EBIT for the year 2. All of you can see the board? Is it okay? I want to push the board a little more, podium a little more front. Is it okay? All of you can see that? Hello? EBIT? All of you? Okay. So PBT is profit before tax. Profit before tax is 1,428. 1,428. So with this, we need to add the interest expenses. We need to add interest expenses. Why we are adding it back? Because this interest expense is deducted to calculate the profit. So what is the interest expense? Interest expense is 392. So that needs to be added back. So plus 392. Okay. Minus the interest income. That is the income from marketable securities. It is given there. Income from marketable securities and non-operating income. So those items are added. So that needs to be deducted. That is income from marketable securities. Income from marketable securities is 210. So that needs to be deducted. Non-operating income. Non-operating income is 140. Okay. So what is that? 1428 plus 392 minus 210 minus 140. How much comes? What's the value? 1470, correct, no?
Yes.
1470. So any clarification, anybody? Hello? Any clarification, anybody? Any doubt, anybody? All of you understood?
Sir, could you please repeat once more, sir?
Yeah. So EBIT is before interest, before tax. So which value we'll have to take? Profit before tax. Profit before tax is the base figure. In that profit before tax, what is deducted? So look at this. Profit before tax, what you got is 1428. In this, what are things has been deducted? We have deducted cost of goods sold, we have deducted selling and admin expenses, and we have deducted depreciation, and we have deducted interest expenses. Okay? So all these items are deducted, then only we have calculated 1428. All of you got it? Okay. So now we are going to get before interest. We are going to get before interest. Before interest means what is to be done? That interest expenses needs to be added back. We should not deduct it. It should not be deducted. So, but we have deducted it. How do we get that? Should be added back. So add it back. Add it. Interest expenses. When we are deducting interest expenses, interest income and non-operating income needs to be adjusted. How do we adjust it? We have added those incomes. So look at that. Net sales 6440, income from marketable securities 210, non-operating income 140. All those things have been added and we got it 6790. So those incomes are added, but it needs to be adjusted. We need to get the before. So since it is added, we need to deduct it. Opposite action we need to do. Deduct it. So if we deduct it, you will get Ebite. Father, got it?
Yes, sir.
Okay. Now we need to calculate. Second one we need to calculate. That's all. Next second thing we need to calculate tax on Ebite. Tax on Ebite. That means whatever the tax that we paid for all these expenses and incomes, that needs to be adjusted. So tax we paid for interest expenses. Tax we paid for interest income. So those needs to be adjusted. How do we add it? The same procedure. The interest expense tax needs to be added. Interest income tax and tax on non-operating income needs to be deducted. Okay? So there is tax on Ebite, tax on Ebite for the year 2. There is tax provision. How much tax provision? So look at that. I mean, the equation is given. Please look at that. Equation is given. Tax provision plus tax on interest income minus tax on interest income minus tax on non-operating income. So tax provision is how much? How much we paid the tax? We paid the tax 448. So tax provision is 448. 448 plus tax on interest expenses. Plus tax on interest expenses. Interest expenses 392. Now, what percentage is the tax? What's the percentage of tax? Anybody? How to calculate tax percentage? Anybody? Tax percentage is not given. How to calculate tax on interest expenses unless we know the percentage of tax?
Total tax amount divided by EBIT 200.
Yeah, correct. So how much is there? not EBIT, profit after tax. Now look at that, 448 is the tax that we paid. 448 is the tax that we paid. What is the, how much we paid? Profit before tax, how much? 1428. So for 1428 we paid 448 is the tax. So what is the tax percentage? Anyone can calculate? 448 divided by 1428. 31 point? Correct, no? So 1428 into 31.3% is 448. Is that got? All of you got it? Hello? Any clarification? 448 is the tax that we paid. 1428 is the tax, profit before tax. So how do we get the tax percentage? 448 divided by 1428. That is 31.3. Any clarification? Anybody? Any clarification? Anybody? So same 31.3% apply here. Okay, so 31.3% on 392. How much comes? 31.3% on 392. How much comes?
123.
123. This 31.3%, how do we get it? 448 divided by 1428. Please, you can write it. Please write, otherwise you, after some time when you revise it, you may not get, how do you get 31.3%? 448 divided by 1428. That is 31.3. So 31.3% on 392. Then minus tax on marketable securities. Marketable securities, 31.3% on 210. 31.3% on 210. How much comes? 31.3% on 210. 31.3% on 210. 65.898. So 65.9. Then minus tax on non-operating income. Tax on non-operating income, 31.3% on 140. 31.3% on 140. 31.3% on 140. How much comes? (31.3% on 140). How much it comes? How much comes? 31.3% on 140. 43.9. So add it. 448 plus 123 minus 65.9 minus 43.9. How much comes? 461.2. 461.2 million. Any clarification, anybody? Any doubt, anybody? Any clarification on calculation? Anyone? Anyone? Any calculation? Any clarification on calculation? Is that clear? Hello? Any doubt?
So I have a doubt.
Ah.
So it's concerning actually Ebite.
Hmm.
My understanding is from Ebite, if we deduct interest, then the PBT will come, so profit before tax.
Correct.
So then why are we deducting interest?
No.
Maybe interest deducting non-operating income.
No. If you deduct interest, you will get profit before tax.
Tax. Yes.
Profit before tax.
Yes.
Correct? So what we want is earnings before interest. Got it? Earnings before interest you want.
Yes, sir.
But what is given there is profit after interest.
Yes. Yes.
Got it? This one, profit PBT, here what is this? Is profit after deducting interest. What you want is profit before deducting interest. How do you get it? Divak?
We add back.
Add back the interest. That's what we have done.
Yeah, my doubt is on non-operating income. What do we-
See, non-operating income. So, as per the definition here, EBIT excludes all this.
Okay.
That is the definition here. In this corporate valuation, definition here is, while calculating EBIT, the following are excluded. While calculating EBIT, the following are excluded. What are the following excluded? 1. Interest expenses, interest income, and non-operating incomes. These 3 items are excluded.
Sir, does it change from question to question or?
No. This is in corporate valuation. This is an assumption.
Okay.
For corporate valuation, assumption is this: to calculate another item. See, the third item is net operating profit less adjusted taxes. That is called NOPALT. Net operating profit less adjusted taxes, which is equivalent to EBIT minus tax on EBIT. Net operating profit less adjusted taxes. So what is that? NOPALT? NOPALT equals to EBIT minus tax on EBIT. That is the definition. Okay, this particular term we are using it for the first time. I mean, the entire finance. Net operating profit less adjusted taxes. Operating profit, net operating profit. Net operating profit means you'll have deduct cost of goods sold. All this needs to be deducted. It's called net operating profit. So you look at here. You have deducted cost of goods sold. You have deducted selling administration expenses. You deducted depreciation. These are all operating expenses. So net operating expenses less adjusted taxes. That is called NOPALT. So what is called net operating profit less adjusted taxes? EBIT minus tax on EBIT. So what is called EBIT here? EBIT means from the profit, these 3 items are excluded: interest expenses, interest income, and non-operating income. Why we are excluding it here? Because we are going to calculate net operating profit. So these incomes, interest incomes and non-operating incomes, are not related to business, or not related to business incomes. So those incomes need to be adjusted. Deepak, got it?
Yes, sir.
We are going to get net operating profit. Those in that operating profit, non-operating incomes need to be excluded. So what are those non-operating incomes? Interest incomes and income from non-operating operations. That is called dividend incomes. So what is your operating income? Operating income is nothing but your sales. That is what your operating income. So look at here. Here the operating income is only sales, net sales. That is 6,440 million. This is called operating income. The remaining incomes Income from marketable securities and non-operating incomes are not related to business. They are not business income. So those incomes need to be adjusted. Then only you will get net operating profit. Clear? Hello? Is that clear?
Yes, yes, sir.
Yeah. So net operating profit less adjust taxes, that's the third question. Third in that's called NOPALT. NOPALT. Okay. That is EBIT minus tax on EBIT. That is the figure what you calculate as per the step 1 and step 2. So 1 minus 2, you will get the third one. That is NOPALT. Net operating profit. Net operating profit less adjusted tax is equal to EBIT minus tax on EBIT. That is 1470 minus 461.2. How much? How much comes? Hello? 1470 minus 461.2.
1008.2.
1000?
1008.2.
1008.2. 1008.2.
Sorry, sir, it's 0.88. 1008.8. Hello.
Sir, good morning. Morning, sir. Yeah. Mail, okay. I'll check. Okay. Okay. Yeah. Oh, you are getting married? Okay. 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 Hello? Okay. Yeah, yes, Deepak, something you were saying, no? Hello?
So the amount is 1008.8, not 0.8.
Yeah. 108, yeah. Yeah. Okay. So the next one is free cash flow. Fourth one is there. What they have asked is free cash flow to the firm. Free cash flow to the firm. FCFF. Free cash flow to the firm. That is, from this information what is given, what we can calculate is NOPALT minus net investment minus non-operating income. NOPALT minus net investment minus non-operating income. That is called free cash flow to the firm. So how do we get net investment? NOPALT already we calculated. So how do we get that net investment? So net investment, net fixed assets at the end minus net current assets at the end minus, net fixed assets at the end plus net current assets at the end minus net fixed assets at the beginning plus net current assets at the beginning. That will give you net investment. Then you'll have to deduct net operating income post tax. That is already we calculated. That is non-operating income minus tax on non-operating income. So here to calculate this, you'll have to calculate the net investment. So what is called net investment? So net investment means opening investment plus closing investment divided by 2, or you can calculate net investment, net fixed assets at the end plus net current assets at the end minus net fixed assets at the beginning plus net current assets at the beginning. Okay, let's calculate. 1 minute. So net investment. plus 1190. 4550 plus 1190 minus 4200 plus 840. 4200 plus 840. How much comes? Got it? Net fixed assets plus net current assets at the end. That is 4550 plus 1190 minus 4200. That is net current assets, it's net fixed assets at the beginning plus net current assets at the beginning. That is 4200 plus 840. How much comes? So first one 4550 plus 1190. How much comes?
For the first one, it is 5,740.
5740 minus
5,040.
5040. So what is the net investment?
So that is 5,740, sir. First one.
5740. Yeah. So 5740 minus
5,040.
5040.
700 is answer.
700 is a net investment. 700 is a net investment. Okay. Net investment. Net investment. Then already that tax on non-operating income that we have calculated already. So how do you get FCFF? FCFF is equal to NOPALT. NOPALT we calculated. NOPALT is how much is the NOPALT? 1008.8, no? So 1008.8 minus 700 minus non-operating income. How much come? Non-operating incomes. Non-operating income is 140. 140 minus 43.9. How much? 140 minus 43.9. 140 minus 43.9. How much? So 1008.8 minus 700, that is net investment, minus tax on, non-operating income post-tax. There is 140 minus 143.9. What's the value?
So final answer is 212.7.
212.7.
7.
212.7. Okay. 212.7. 212.7. Any doubt? Any clarification? Anybody? Any doubt? Any clarification regarding the calculation of free cash flow to the firm? For all this calculation, what needs to be known is definition you need to know very clearly. Then you can calculate that. Any doubt, anybody? Free cash flow to the firm is NOPALT minus net investment minus non-operating income post-tax. Shall we go to next? The last one is financing cash flow. I wanted to refresh what you have done for the accounting. That is, you calculate a cash flow statement, what is called financing cash flow. What are the cash flow related to financing? What are these? Anybody? Huh? If you redeem debenture, it is a cash outflow or cash inflow? If you redeem the preference share, cash outflow or cash inflow? Hello?
Redeeming debentures is cash.
cash outflow. So financing cash outflow. So please listen. Financing cash inflow and financing cash outflow. Financing cash inflow and financing cash outflow. The financing cash inflow is higher than the financing cash outflow. We call it net financing cash inflow. Net financing cash inflow. If financing cash outflow is greater than financing cash inflow, it is known as net financing cash outflow. Hello? If the inflow is higher, it is called net financing cash inflow. If the outflow is higher, it is called net financing cash outflow. Now we need to know what are the items comes under financing cash inflow and what are the items which comes under financing cash outflow. Now first of all, we need to know what is financing. Financing means raising funds. Raising funds. That's called financing. So what are the activities related to raising funds? What are the activities related to raising funds? One is we issue shares. When we issue shares, so when the company issues shares, the company receives money. That is called financing cash inflow. Issue of shares, issue of debentures, issue of preference shares. These are all financing cash inflow. Opposite, that is redemption. We cannot redeem the preference equity shares, so we call it share buyback. Equity shares can be bought back. Wipro is buying. Wipro is buying the shares back. So share buyback is a financing cash outflow. Redemption of preference share, it is called financing cash outflow. Redemption of debentures, it is called financing cash outflow. Then second one is you raise loan. You take loan from the bank. You take loan from the company, takes loan from the financial institutions. That is raising funds. So when we raise a loan, it is called financing cash outflow. When you repay the loan, it is called financing cash outflow. Okay? Then expenses and incomes related to these expenses and incomes related to these activities. So when we issue the shares, the company needs to pay the dividend. So dividend payment is a financing cash outflow. Financing cash outflow. When we buy the shares from of other company, we receive income. We receive dividend. It is called dividend received. That is financing cash inflow. So dividend payment is financing cash outflow. Dividend received is financing cash inflow. So when we raise loan, the company needs to pay the interest. So interest paid. Interest paid. That is called financing cash outflow. Interest received. Sometimes we give loan to others. That is called financing cash inflow. Interest received, financing cash inflow. So financing, these are all the total financing cash inflow and outflow items. Okay. So we'll have to calculate all this. So what is called financing cash inflow? It is given, notes is given here. Please look at this. Net financing cash inflow. Net financing cash inflow. It's called financing cash inflow minus financing cash outflow. So what are the financing cash inflow? Financing cash inflow is net borrowing. We borrow from others. That is cash inflow. Share issue, financing cash inflow. Dividend received, post-tax. It is financing cash inflow. Interest income, we receive income from others. That is called financing cash inflow. Opposite, financing cash outflow. What is that? Repayment of debt. Redemption of preference shares or share buyback. Purchase of new shares. You are buying new shares from others. There is a new investment. That is the financing cash outflow. Dividend paid, financing cash outflow. Interest paid, financing cash outflow. Got it? Anybody? Well, understood? Financing cash inflow, financing cash outflow. If the financing cash inflow is higher, it is called net financing cash inflow. The financing cash outflow is higher, it is called net financing cash outflow. Any clarification? Anybody? Financing cash inflow, financing cash outflow. Hello? Is that clear? Is it okay? Shall we proceed?
Yes.
Okay. Now, Look at here. Look at here. Let us take the inflow, financing inflow. Share issue. Look at that share issue. Any share is issued. Look at that equity capital. Any share is issued. Hello? Can you look at that balance sheet? Any share is issued? No. 2,100, 2,100. No share issue. No financing cash inflow. No issue of shares. Look at the debt. Debt is 2520, 2940. You borrowed more? The company is borrowed more? Hello?
Yes, sir.
Yeah. So what's the difference? 2940 minus 2520. 2940 minus 2520. How much?
420.
Huh? How much? 420. So 420 is a new borrowing. 420 is a new borrowing. That is called financing cash inflow. Financing cash inflow. I'll write here. Financing cash inflow. So financing cash inflow. Financing cash inflows. What is that? New borrowings. So new borrowings how much? That is 2940 minus 2520. 2940 minus 2520. How much? 420, no? 420. 420. Okay? Now, next one. Then you have non-operating income. Non-operating income. How much we received? Financing cash inflow. Non-operating income. Dividend received. Look at this here. Income from marketable securities. How much is there? 210 is there, no?
Yes.
Income from marketable securities. Non-operating income. How much?
70.
No. I'm talking about second year. 210 and 140, correct?
Yes.
210 and 140. So 210 minus tax. Tax on marketable securities, how much? Tax on marketable securities. 210 minus 65.9. Income from marketable securities. It's nothing but interest income. That is 210 minus 65.9. 210 minus 65.9. How much? 210 minus
144.1. 144.1.
144.1. Then non-operating income. That is called dividend received. That is called dividend received. Bracket you can write dividend received. How much? That is 43.9. No, 140 minus 43.9. 140 minus 43.9. How much? 140 minus 43.9.
96.1.
96.1. Okay. Look at anything else is there. Financing cash inflow. You received a dividend. We received new borrowings. No issue of shares. Then dividend receipt is written. Interest income written. Only 4 items. Out of 4, 1, 2, 3, 4 items. Out of 4 items, 3 items are there because share issue is not there. Then look, go to the financing cash outflow. Add it. Add this. Add the total. Add this total. Then you write financing cash outflow. Financing cash outflow. What is financing cash outflow? That is repayment of debt. Debt is not repaid because we borrowed more. no repayment of debt. Redemption of preference shares, preference share itself it is not there. Purchase of new shares, look at that. Purchase of new shares. Look at the asset side, investments. Investments. Look at the first year, 1,260. Second year, 1,400. Correct, no? Purchase of new investments. First year is 1,260. Second year is 1,400. What's the difference? Difference, what is that? Difference 140. What is that 140? What is that 140 called?
Cash outflow.
Cash outflow. What is that? You bought new shares of other companies. You bought new shares of other company. So purchase of new shares. Purchase of new shares. That is 1,400 minus 1,260. That is 140. 140. Okay. Then we have interest expenses. Interest expense. How much? 392. Interest expense. Interest paid. It is cash outflow. Financing cash outflow. 392 minus post tax. 123. 392 minus 123. Post tax. Interest post tax. How much? 392 minus 123. 392 minus 123. 60? 269. Then dividend paid. Dividend paid. Dividend paid, there is no tax. Because the company is paying the dividend. The company
8.8.
308.8. That is called financing cash outflow. Cash outflow is higher than cash inflow, so it's called financing cash outflow. So any clarification, anybody? So from the information what is given, we need to cull out the information. We need to cull out the information what are called financing cash inflow, what are called financing cash outflow. Financing cash inflows are, the money that we receive, the company receive through financing activity. That is issue of shares, getting new loans, dividend received, interest received. These are all financing cash inflow. Opposite is financing cash outflow. There is redemption of shares, redemption of preference shares, redemption of loans, repayment of loans, and dividend paid, interest paid. So dividend paid, interest paid, you need to adjust the tax. Income received, you need to adjust the tax. Dividend received, dividend paid, you should not adjust the tax because you pay dividend after paying the tax. Okay. Any clarification, anybody? Financing cash inflow, financing cash outflow. So this can be another type of case study which can be asked. So we looked at the valuation of a company. So you may be given 2 years balance sheet of profit and loss account of a company, and you may be asked to calculate these items. Okay, it's another type of case study. So thank you very much.